Hello and welcome to Fund to Money. Here we will discuss the risks related to bonds that you cannot afford to ignore. So we are talking about bond investments. What is the background? Well, markets are volatile. Some people are already calling it bear markets. They probably are bear markets. There are definitely, you can call them volatile markets. So when markets are very volatile, one day it's going up, one day it's going down, you're seeing your portfolio, you're nervous. People are telling you to buy bonds and they're saying that it's the fluctuations are less and you can get high returns. So what we are going to do, we are going to tell you the risks that are there when you are investing in bonds, which people tend to often ignore, and the risks that are right now there in the horizon, that they are already there thanks to high inflation, rising interest rates, and an imminent global slowdown. So what bonds are supposed to do, they are traditionally meant to help you reduce the fluctuations in your returns. One day your portfolio or mix of your investments is showing a particular return, the next day it's showing something else which is making you lose sleep. You want to go to invest in make investments where the fluctuations, so that the overall fluctuations are less. Bonds are supposed to do that, and that's right, but what people often ignore is they bring with them certain risks, and if you are not aware of those risks, you might end up suffering quite a bit. Right, so we'll be discussing these risks which people often tend to ignore, and they somehow think that because bonds are less volatile, which they are, their volatility, upward and downward movements of the prices are far less the degree, and they're for far shorter periods of time than equities. That's true, but they don't. It's not true that they don't have risk. They have very formidable risk, which you must be aware of, and higher returns, most importantly, higher returns if they come from bonds, they're coming from bonds, they are actually coming with very substantial risks. So we'll be discussing those risks that will come, and of course in this whole environment, how you should be looking at bonds, because those risks are very important. So we'll be discussing them on the other side of a short break. Before we take that break, we'll urge you to subscribe to our channel, take advantage of all the discussions we have, numerous discussions we have on various topics on personal finance, numerous topics on investing, and subscribe to our channel and get connected with us on all leading social media networks. So we'll be back on the other side on discussing with you some of the very important risks that you should be aware of, which people tend to ignore as far as bonds are concerned. So don't go away. Welcome back. Welcome to Fund to Money. We are discussing about the risks related to bonds, which people tend to ignore. So the background is this: where in volatile markets, in bear markets, in correcting markets, there's a lot of volatility in equities, and equity investors, they want to go to a place, they want to make investments where the volatility is less, the overall returns of the investment mix goes down, they can earn decent returns. So there's a certain stability in returns which they want, and they want to look at bonds. Bonds actually do that. The volatility is far less pronounced, they last for a lesser period. However, they do come with risks. So there's this whole conversation that goes on every time these situations happen, and it's happening now, that as if with a very low risk you can get high return. That's not true, and we'll here explain. And of course, right now there are other things that you need to keep in mind, which is high inflation, rising rates, interest rates, and of course an imminent global slowdown. That is obviously India is not going to remain untouched by it, despite growing, although it's expected to grow pretty well. So let's jump into the factors one by one. Before we take these factors, let's remember one thing. From in bonds, if you want returns, it can come to you from two sources. One is the interest or the coupon payment, which the issuer is committed to giving you, is legally responsible for giving you that interest payment or coupon payment twice a year typically. So they're supposed to do that. So that's number one. It's unlike equities or stocks where your dividend announcement happens. So it depends totally on the company and its profitability situation and its decisions. So that's number one. Second is capital gain. So the bond prices move up and down, and you by selling the bond you hope to make a gain. So there's a capital gain, capital appreciation part of it, there's an income part of it. Similar in equities, there's a dividend part of it, and there's a capital gain part of it. You're not looking at dividends so much in equities. In bonds, the coupon payment or interest payment is far more important, because they typically form a larger part of the earnings, right? But because the bonds are traded, so the price moves up and down. If you sell them, you can make a gain. But that is where the issue comes in. That's also the differentiating factor between a fixed deposit and a bond. Because fixed deposit is not listed, you are holding it till the end. In bonds, you can hold it till the end, or you can make an exit before. However, when inflation is happening, interest rates are going up, what's happening is the prices of bonds are coming down. So therefore, what's happening is that portion, the capital gain or capital appreciation portion, is unlikely to come your way. So therefore, it's the income part of the bond that is becoming more and more important. That's the part which you're likely to get. That in any case is the part which is the larger part, the most substantial part of bonds. That is also the part which is helping bonds stabilize the return of your portfolio. So you need to keep all these things in mind. Now, if that be the case, if you are going to chase higher returns from bonds, it has to come from higher interest or coupon payment. The moment you are starting to do that, what you will find is one of the ways you will get at it is for longer term bonds. So bonds which are going to mature after a longer period of time, they will progressively offer you higher returns. So where's the problem? The problem is this: longer term bond, longer the term of the bond, longer you hold, longer the term of the bond, more fluctuation in the price of the bond. So that becomes a problem. If you're going to get nervous about the price of the bond going up and down, then you have a thing to think about, because higher returns will come from a longer term bond. So that's one of the ways by which you can chase higher returns in bonds. So you need to ask yourself why you are buying the bonds. If it is for stability, it is fine. But the moment you start thinking that you'll also get a higher return, that will happen. One of the ways you can do it is you go for a longer term bond. That's where you're going to find a higher return, but that is going to give you fluctuation, volatility in bond prices, which was something that you wanted to actually avoid. So that's why these risks are so important for you to be aware of, because if you are going into them without understanding these risks, you will obviously be disappointed, right? So let's take the next risk, which is the repayment risk or the credit risk. Basically, the risk of the issuer of the bond, the organization that has issued the bond, not being able to pay you the interest or the principal, or maybe both, right? So these risks are always there with bonds. They are also there with fixed deposits, right? So it's not as if it's a new risk. This is a risk that you should be aware of. And it's not as if bond defaults don't happen. You look around, bond defaults are happening all across the world. They typically happen in any point of time. When in situations like this, when the global economic conditions are turbulent, they happen a little more. During downturns, they happen even more. So if there's a global downturn which is being expected, then you can expect some companies, or a significantly higher number of companies, actually defaulting. Now, where's the problem? Typically, you get higher returns from companies which have a higher credit risk, right? So the higher the risk of repayment default of a company, they are going to offer you higher interest rates. So if you are going to be chasing higher rates, returns from bonds, the likely destinations from where, likely sources from where you're going to get higher returns, higher coupon rates or interest rates, are going to be those with lower credit ratings, where the chances of default are higher. Of course, credit rating agencies rate the risk of default of bonds. That's what they are supposed to do. So in a global downturn, you will obviously not be able to. Prudence demands that you should go for highly rated, top rated bonds, or at least investment grade bonds. That means that without taking higher risk of default, you will not be able to get higher returns. There's a limit. So the moment you go chase returns, you're taking bonds of a risky organization which can there's a risk of default. So this whole notion that you can get higher returns with lower risk is actually a myth. So this is something which is so important for everybody to realize when they're investing in bonds, right? So you obviously have to go for investment grade bonds, and they will come there will be a limitation to the returns that they can give. As we mentioned, the capital appreciation is a challenge, so therefore you'll have to look at coupon payments. Then there's the reinvestment risk. So when your investment matures, whether it's fixed deposits or bonds, you have to reinvest it again. Where's the problem? Problem is you have to look for a rate from a bond which is attractive enough. Now in a fixed rate bond, there's a problem during periods of high inflation, because any bond that you hold which is a fixed rate bond will progressively become more and more unattractive. Why? Because there are new bonds that are being issued at higher rates, so the value of your bond will keep going down. So of course, capital appreciation, again, there's one more reason why you're not going to get capital appreciation. The other part is there are a couple of problems that come up, which is that if you try to exit the bond midway before maturity, you don't get a capital gain. Now the question is, if you hold till maturity, till the end of the term, what's happening is that all the higher rate bonds, you're not being able to tap on them. So there is that problem. Now the same problem will come if you reinvest a maturity amount, a bond maturity amount, maturity proceeds again in a bond, because again subsequently there'll be bonds that will be offered at higher rates. So that is a problem, whether it's reinvestment, whether you're doing it otherwise. So that's a problem that's going to happen. Now there are variable rate bonds. But the point is, those typically you're going to find their rates are linked to some benchmark rate. It could be government security rate or any other rate. Now typically you're going to find their rates to be lower than fixed rate bonds, and you will obviously be challenged out there as well. So there is the reinvestment challenge that happens when you are in any case when you're investing in bonds or fixed income investment. This would be a challenge even for fixed deposits, right? However, in a high inflation scenario, especially with bonds, this is again becoming a challenge. So it's not as if that this risk is not playing at all. It's playing a very, very big role. It may work to your disadvantage. Finally, there's the inflation risk. So we have told you what are the problems which inflation causes, but in the long term, what does it do? In the long term, bonds, when you invest in bonds, if you're investing in long term bonds, you typically would find that your growth of your money is lagging behind inflation, right? So therefore, through bonds, you will never be able to, it's very likely that you will not be able to amass or accumulate very large sums of money. So what can bonds do? They can do what people say in the first part of the pitch, or part of many sentences, which is reduce the volatility, the up and down, the headache of watching your investments go up and down. That is something they can do, but they can never give you the kind of high return that you need for very important goals such as your retirement. You cannot be solely dependent on them. Retirement of children's higher education. The truth is if you want higher returns, you will need to take higher risk, and if you're taking higher risk, you might as well take higher risk with equities and smartly manage it. So the whole deal is you have to smartly manage your risk, be aware of them, and bonds are no exception. They carry their own risk. So we hope you found this useful. Just in case you're thinking of buying bonds and investing into them, you'll keep them in mind, especially in these conditions, and benefit. So we hope you found this discussion useful. If you've liked it, hit the like button and share it with others. Take advantage of all our discussions which are there in the playlist, and otherwise get connected with us on all leading social media networks. Subscribe to our channel. Till the next time, take very good care of yourself, and goodbye.